Treasury management for real estate investors. In my last video, I laid out a framework I believe every future real estate investor will need to have if they're to remain profitable and ultimately exceed newly established hurdle rates. At the center of that framework is your Bitcoin strategy. Since it's the most important piece, that's where I'm going to start. And today I'm going to cover the top 3 things you need to know. First is, what is treasury management and why you need it? 2, real world examples. And 3, I'm going to run through custody best practices. Treasury management is just a fancy way of saying cash management. It's about how you protect, grow, and allocate capital across time. In today's environment, if you're holding 100% of your reserves in US dollars, you are unintentionally eroding your wealth. You're losing purchasing power every single year. So by allocating a portion of your reserves into Bitcoin, you can accomplish 3 main objectives. The first one is preserving your purchasing power. Second is you're able to maintain and build adequate reserves for maintenance and capital expenditures. And third, you're improving your creditworthiness over time. So let's say you own a property, it's kicking off $500,000 a year in free cash flow, and you decide to allocate 10% of it, $50,000 per year, into Bitcoin. The remaining $450,000 is for immediate and operational needs. Now, you do this strategy for 5 years, and over that 5-year period, Bitcoin grows at 55% per year. At the end of that 5 years, your Bitcoin treasury would be approximately $1.58 million versus the $250,000 you would have in your US dollar reserve. So this is an incredible, powerful strategy. I actually know an investor that implemented this about 6 years ago. And today, the Bitcoin treasury is more valuable than the property itself. So it's not just about capital preservation, it's about capital growth as well. And that is incredibly important because you have to exceed the rate of monetary debasement. And if you watched my first video, you know that it has been about 9.8% per year since 2009. So this is a lot more than just numbers on a spreadsheet. We're talking about implementing strategic flexibility into an illiquid asset class. So I'm going to run through a couple examples here, but before I do, I want you to keep this this Bitcoin treasury example in mind as I run through them. You have a Bitcoin reserve of 1.58 million, and you have a US dollar reserve of 250,000. So the first one is there's some kind of downturn. Maybe you find yourself in a different interest rate environment or some kind of emergency expense. If you don't have a cash reserve, or that reserve is not large enough, you are forced to sell at the worst possible time. This is where your Bitcoin treasury steps in because you can access 24/7 global liquidity and bridge that expense without having to do a fire sale or introducing any more complexity into your situation. So emergency situations aside, let's talk about leasing here for a second. Depending on the market and the property type, securing a new lease can cost anywhere from 20 to 25% of the total lease value once you factored in downtime, marketing, tenant improvements, and transaction costs. Not to mention, these are all upfront expenses. So this is another scenario where your Bitcoin treasury becomes a real solution. How about operating expenses? Most of your leases have 2 to 4% annual escalations. Well, what about electricity, insurance, maintenance, admin? All of these expenses are increasing faster than your lease escalations are. So Bitcoin allows you to absorb that delta and not only stay solvent, but reinvest and improve the asset throughout the market cycle. If you signed a 5-year lease in 2019, you've gotten absolutely crushed. And now you're trying to renew your tenant in a down market with lots of competition. And before someone slides into the comments and says, well, I own triple net properties and my tenants pay all my expenses. Okay, fine. I would urge you to reconsider that for a second, because in the last cycle, we all saw the upper limits of what the market was willing to bear in terms of asset values, expense increases, and rental rates. And to think that your tenant, either current or future, is just going to absorb all of these increases in perpetuity, I think is incredibly nearsighted. There are downstream implications, negative ones, that are both business and societal in nature. So again, I would urge you to reconsider that position. The last example is more for the mom and pop owners out there, but it's still really critical. We've established that the system is stacked against you, and inflation makes it impossible to maintain your reserves, which in turn makes it really difficult to cover unexpected repairs, let alone improve the asset. So this is where your treasury comes into play again. Not only can you cover those unexpected repairs, but you can once again improve, reinvest, and add value to the real estate, which in turn is going to help you build wealth again through the real estate. So what are we doing in each of these examples? We are using a new tool, a new innovation that complements and enhances the real estate portfolio. We are not replacing anything. One of the most important and overlooked parts of this conversation is custody. Bitcoin is a bearer instrument. That means that you can hold it directly. There's no counterparty required. That is an incredibly powerful concept. But with great power comes great responsibility, and the right option depends greatly on the corporate structure and the amount of funds that we're talking about. So there are three main options when it comes to custody. The first one is self-custody in cold storage. This is ideal for those small private investors that are allocating smaller amounts or just want full control. The second option is a multi-signature wallet. This is a shared key structure that enhances the overall security, and it eliminates single points of failure. The third option is multi-institutional custody. This is for the larger treasuries and the firms that have various compliance requirements. Now, it's really important to note that in all three of these setups, you are not giving up control of your Bitcoin. Now, what do you want to avoid? First of all, don't buy Bitcoin only to leave it on the exchange. That brings its own set of issues with it. The second one is try not to just buy a Bitcoin ETF. Yes, you're going to get the price appreciation, exposure to the upside, but you're losing out on the benefits of the bearer instrument, the self-custody, the self-sovereignty, the permissionless access, and the all-important global liquidity. So it's incredibly important to take the time and learn about these options so that you can make an informed decision and harness the true power of this strategy. And here's what far too many people are missing. This is not theoretical. This is not fringe. It's happening right now. There are over 160 publicly traded companies that hold Bitcoin on their balance sheet, and it's growing every single day. There are 3 US states that have already passed laws enacting Bitcoin reserves, and there are 15 more that have policy in various stages of the process. So eventually, all businesses are going to own Bitcoin. The only question is, when will you? So whether you're a brokerage, a developer, a syndicator, a property manager, or a general contractor, I challenge you to think differently and consider this strategy, because those that adopt it first are going to benefit the most. If you have questions, drop them in the comments or DM me. Remember, there are no dumb questions. We are all in this together and learning together. I'm going to ask you to share this, share it with your clients, share it with your team, share it with your community. I need your help spreading the word. I appreciate you stopping by, and I look forward to seeing you here next time.